What if I told you that the money in your bank account isn't really yours? Not because someone will steal it, not because the government will freeze it, but because without you noticing it was engineered from the very beginning never to belong to you in the first place? What if every dollar, every euro, every yen is part of a closed system built by a handful of financial architects who designed money itself to function like shackles, digital shackles? And what if this system didn't start in the age of computers, but in dimly lit rooms more than a century ago, long before the world knew what globalization even meant? Today, we're going to pull back the curtain on the hidden bank cartels that reshaped global currencies, dismantled national independence, and locked modern societies into a digital financial cage, one quiet reform at a time. Stay with me because the story begins long before the world went digital. To understand how currencies became digital shackles, we have to rewind to the early 1900s, a time when money was still metal. Economies were simpler, and the idea of a global currency system was unthinkable. But behind the scenes, a seismic battle was underway. A small group of influential bankers, financiers, and political insiders were watching something very carefully. Industrialization. Factories were exploding in size. Trade networks were expanding. Nations were borrowing money like never before. And these early financial elites realized a world-changing truth. If you control the supply of money, you control the direction of civilization. But metal-backed currencies were a problem. Gold and silver couldn't be created out of thin air. They couldn't be manipulated isolated. They couldn't be scaled to match the explosive growth of modern banking. So these early architects needed a new system, one that centralized power, one that was flexible, one that allowed credit, not gold, to drive the economy. And in 1910, on a small island off the coast of Georgia, the blueprint was drafted. The now infamous Jekyll Island meeting. A meeting that wasn't recorded, that used fake names, that the attendees denied for decades, but its outcome changed modern money forever. The goal of the Jekyll Island conference was simple: create a central banking system that looks public, but is controlled privately. The result was the Federal Reserve System of the United States. And with it came the first major shift in global currency power. For the first time in American history, the authority to issue money, a power the Constitution gave to Congress, was handed to a hybrid institution controlled by a coordinated network of banks. This wasn't just an American change. It became a model. Over the next 50 years, central banks, often designed with the same blueprint, emerged across Europe, Asia, and later the developing world. The public believed these institutions were guardians of financial stability. But insiders knew something deeper was at play. These central banks weren't just stabilizing economies, they were quietly standardizing them. The global financial system was beginning to centralize, but the real transformation was still ahead. Because central banks weren't satisfied with controlling money, they wanted to control what money is. From the end of World War II to the 1970s, the world lived under a currency compromise called the Bretton Woods system. Nations pegged their currencies to the US dollar. The dollar was pegged to gold. This meant money still had an anchor, a limit, a constraint. For the bank cartels, this was a problem. The more trade expanded, the more governments borrowed, the more corporations needed financing, the more obvious it became that gold couldn't support a global economy that was ballooning faster than any natural resource. So in 1971, with little warning, the last restraint was cut. President Richard Nixon announced that the US would no longer redeem dollars for gold, and overnight, money stopped being something with intrinsic value. It became a promise created by debt, a promise issued by central banks, a promise controlled by financial institutions, a promise that could be expanded infinitely. This was the breakthrough the hidden cartels needed. Once money became debt, money creation became centralized. Once money creation became centralized, control of the global economy tightened, but the public didn't notice, because the change was invisible. People still held dollars and euros and yen, but those currencies were no longer backed by anything except the confidence managed by the very institutions that issued them. And this wasn't the end of the evolution. It was the beginning of the trap. As the 1980s and 1990s arrived, two things happened simultaneously. 1. Banks began digitizing money. 2. Governments deregulated financial markets. This combination was explosive. Digital money was easier to move, easier to lend, easier to multiply, and easier to control. Once currency became digital, the old constraints vanished entirely. There was no physical limit, no accounting limit, no material anchor. $1 trillion could be created in a spreadsheet before lunch. and the people who controlled the financial pipelines could now freeze accounts, track transactions, redirect capital, inflate away savings, transfer wealth upward. Quietly, the public didn't fully understand what digitization meant. GDP was rising, markets were booming, credit was flowing like water. But behind the scenes, debt became the beating heart of the entire system. In 1970, global debt was about $2.5 trillion. By the early 2000s, it was over $80 trillion. Today, it has exploded past $300 trillion, more than 340% of global GDP. This isn't an accident, it's a feature. Because once currencies go digital, once central banks can create limitless credit, once private institutions can profit from every new dollar of debt, the entire system becomes a machine that must keep expanding forever, and if it stops, the whole structure collapses. By the early 2000s, the transformation was complete. Money was no longer a tool, it was a system. And that system had side effects, some predictable, others catastrophic. 1. Savings lost value faster than ever. Inflation became an invisible tax that silently transferred wealth from the public to institutions that control asset prices. 2. Crashes became more frequent and more profitable. 2000, 2001, 2002. Each collapse wiped out ordinary people while concentrating more power among central banks and the largest financial institutions. 3. Nations lost monetary sovereignty. Countries with their own currencies still found themselves dependent on global liquidity flows, international banks, bond markets, and dollar-denominated debt. 4. Digital surveillance became baked into finance. Every major financial authority now has real-time access to transactions that would have been private decades ago. 5. Asset inflation priced entire generations out of homes. When money is created through debt, assets rise faster than wages by design. 6. Wealth inequality exploded. Not slowly, not gradually, but exponentially. Because the digital money system rewards those closest to the money printer, the institutions, who get new liquidity first before the rest of the population feels the inflation. This structural advantage has a name, the Cantillon effect, and it cemented financial power in the hands of the very cartels who designed the system. Governments and central banks attempt reforms every few years: stimulus checks, quantitative easing, raising rates, cutting rates, guarantees, liquidity injections, digital compliance frameworks, macroprudential policies. But they all have one thing in common: none of them change the core architecture of the system. Why? Because every attempted fix assumes the same thing: more money will solve the problem. But money is the problem. Money created as debt. Money issued by central authorities. Money controlled by private-lined institutions. Money tracked digitally. Money that must grow faster every year just to keep the system alive. Each solution ends up reinforcing the core problem. Bailouts reward the institutions that cause the crisis. Low interest rates make borrowing explode. High rates make governments drown in interest payments. QE inflates asset prices. Banking regulation increases consolidation. Emergency liquidity becomes permanent liquidity. These aren't fixes. They're patches on a machine that was built to malfunction because malfunctioning creates profit. And now we're entering the next phase of the cycle. Today, the most powerful financial institutions are pushing the next evolution of currency control: CBDCs, central bank digital currencies. Unlike today's digital money stored in bank databases, CBDCs are programmable. That means every unit of currency can be tracked, spending can be limited to approved categories, savings can be penalized or expired, transactions can be blocked, taxation can be automated, individuals can be financially switched off. This is not science fiction. Dozens of countries are piloting CBDCs right now, and here's the twist: the digital shackles were built long before CBDCs. CBDCs just make them visible. The architecture has been growing for 100 years. CBDCs are simply the final lock clicking into place. When money becomes fully programmable, financial autonomy becomes optional, privacy becomes extinct, monetary freedom becomes conditional, and control becomes frictionless. This is the world the hidden bank cartels envisioned when they standardized central banks, severed currencies from gold, digitized money, and linked global markets. The shackles were invisible at first, then they became digital. Now they're becoming permanent. 1. The global currency system wasn't designed naturally, it was engineered. From central banks to fiat currency to digitization, each phase centralized more control in fewer hands. 2. Digital currencies accelerated a century-long plan. Once money went digital, the system gained surveillance, programmability, and near-total centralization. 3. The next phase, programmable money, threatens financial freedom directly. The tools of control are already in place. They're simply waiting to be activated. We're reliving through a transition that future historians may describe as the moment money stopped being a medium of exchange and became a mechanism of control. The question isn't whether digital shackles exist. They do. The real question, the one still unwritten, is whether society chooses to recognize them before they fully lock into place. If you found this story eye-opening, share it. The more people understand how the modern currency system evolved, the harder it becomes for quiet reforms to reshape our freedoms without debate. For more deep dives into the hidden mechanics of global finance, subscribe, turn on notifications, and stay with me, because the next episode reveals the origin story behind the most dangerous economic myth ever created.